Good afternoon. Welcome to the Business Boardcast. I'm Nikki Larkin. I'm your host, and today we are joined by Tom Pike. Welcome, Tom.
Hello, good to be here. Thank you.
So we are going to be talking about inheritance tax, which seems to be very popular. Not the actual tax, but the seminar. So that's great. We're going to go through quite a few different things. So please do stay on to the end if you can. Also, there is the opportunity to post questions. If you're watching live, you can post questions, whether it's on LinkedIn or YouTube. If you pop your question into the comments, it should come up onto my stream. So even just do say hello so that I know that my stream is working for the comments. And I will intersperse today's talk from Tom with the various questions. So we've got quite a lot to go through because this is a massive topic. So we are being a bit picky about which bits we're going to be going through today, because we're thinking if this is our sort of intro one, we will go in depth on some parts of this at a later date. But okay, this is where we're going to start. So, Tom, when you're talking to people, your clients, I'm talking to my clients, what are the things that the people are generally concerned about IHT? What do they worry about?
The short answer is lots of things. So you're quite right. It's a hugely controversial tax, probably the most controversial tax. It causes the greatest emotion and upset and I guess sort of disdain by everyone who sort of finds themselves having a conversation about it. Generally speaking, people are worried that their hard-earned money that they've been stashing away and saving up throughout their lifetime and their wealth is going to get given away and going to get given away to the tax man instead of going to their family and their wider loved ones. It might also be that they're concerned about what untimely death means for their family unit or their business. Because, we like to think of death as something that's far off in the future when we're old and long in the tooth, but life holds no guarantees. So those are the two main things and sort of areas of concern that people would be worried about. And we all talk about it, we might joke about it in the pub, that there's two certainties in life: death and taxes. Inheritance tax or IHT is sort of like the evil child of both of those things, really.
But hopefully from what we're going to go through today, we may be able to help you mitigate at least some of it. So
absolutely,
before we go into further detail, just, because there is still some confusion about what is inheritance tax. So can you just go through what are the levels of what the nil rate band, where are we at the moment, Tom?
Yeah, so inheritance tax or IHT is a tax on the value of someone's estate. So when they die, all the things that they own, whether it be liquid assets, investments, or their home, jewelry and expensive watches and cars, all the things that one owns, that's your estate. If your estate falls above a certain amount, then 40% of that is owed to the taxman in inheritance tax. And the amount that I'm talking about is called a nil rate band. And everybody has a nil rate band, and it's £325,000. So 325k. And what that means is,
with Southeast property prices isn't very much, is it?
Yeah, no, absolutely. So in the Southeast, especially where you and I are, property prices are high and they're rising. And they've been rising, incredibly so over the past few years as well. What that means is people are nowadays more likely to have an inheritance tax liability than they were, because it was once seen as a tax for the wealthy. But because of rising house prices, more people face the liability. But the government have done something about that. So I explained that everyone has £325,000 as a threshold. It's the amount above that threshold on which you are assessed for liability to IHT. So the government introduced what's known as a residence nil rate band. And it's a further threshold specifically designed to protect the value of the family home being left to direct descendants, children, grandchildren, and that's £175,000. to 175. So you've got your normal nil rate band of 325, your residence nil rate band of 175. Now, if you're married or in a civil partnership, on death, assuming none of it's been used up with lifetime gifting, which we won't go into in this call, that can pass to your surviving spouse or civil partner. So what that means is the total value, if you've got 500 and 500 of the two thresholds, is £1 million. So a short, sharp, back of the envelope calculation, you can say if your estate is below £1 million, you'll likely have no liability to inheritance tax.
So good reason to get married or have a civil partnership.
Yeah, marriage is a form of tax mitigation, definitely. That's what I keep telling my girlfriend anyway.
Yeah, that's one area where it saves you money.
Yeah, it's not very romantic though.
And it's only you can only get the two, so thruples don't count. It's just for standard marriages and civil partnerships. Yes, okay, so that's what we've got. You can so 2 lots of 325s, 2 lots of 175s, £1 million. Excellent. So that's good. We know what we are, where we are with how much it is, and currently what the 40% is, because as we know with taxes at the moment, who knows what they will be from one week to the other, but that's what it is. And it has been that for quite a while. So has been a bit of a constant. And those nil bands have been the same for quite a while as well. There's been no inflation to those bands either. So what can, and this is going to be the key thing and why people are tuning in, what can people do to proactively mitigate IHT besides just giving it all away and joining nunnery?
Well, that is a good plan, and it is an effective plan. But if you don't want to do that, there are a number of things you can do. Now, everyone's expecting me to say what I'm going to say next, and that's seek advice. And it is important because tax is complicated anyway, and mitigating tax effectively is actually hard to do if you don't have the know-how. You know, last year the HMRC received £6.1 billion in inheritance tax, which is an increase in 14% or by 14% on last year. And they believe, perhaps crushingly, that was all paid needlessly, on the understanding that with careful planning and consideration, inheritance tax liabilities can be reduced. So seeking advice is supremely important, and everybody should do it. What they should also do is be speaking to a solicitor, like a private client solicitor, and talking to them about getting a will done. It's that life chore that we always put off, but a will is so important. Everybody who speaks to me, and I don't do wills, but I just nag people to get them done. Everybody speaks to me, says, my will's really simple. You know, I don't have much going on, this and that and so on. But if you have business interests, if you have children, you know, if you have children who have children, otherwise known as grandchildren, then, you know, it really does mean that your will is not simple automatically, just by virtue of those few things there. So a will is really important. Lasting powers of attorney, they are such an important document as well. And for those that don't know, if you lose mental capacity because through illness, like dementia, for example, or if someone was in a coma, you're not dead, so your will is null and void.
I've said before, I had a client fell off a roof and went into a coma for a long time. Really important. They didn't have a power of attorney, caused big problems.
Absolutely, and it causes massive problems for the family at a time when, you know, what they need is simplicity and time to heal and adjust to what's going on. What they don't want is this horrendous paperwork trail, which would also be very expensive. So lasting powers of attorney means, and there's two types, it means that you can act on behalf of the individual who has lost mental capacity. So the two types are health and welfare, so that's to do with one's medical and physical needs. And the other is property and financial affairs, which does what it says on the tin. It's so important that if you have a business, that you put clauses in your will and both types of lasting power of attorney that specifically relate to your business interests. Because Nikki, if you and I are married and something happened to me and you wanted to make decisions on my behalf about my business, you couldn't do it if you didn't have a specific, you know, if I didn't have a business lasting power of attorney in place. So that's really important too. Other things people should do is consider, in the event of their death, whether that be
Sorry, I
tomorrow.
would just point out there,
Yeah.
I mean, lots of the people out there will have multiple directors and things, but if you do happen to be a single director, it is worth putting a company secretary in place. Not that they necessarily have too many powers, but they can at least, if you were incapacitated, can at least talk to Companies House on behalf of you for that company. So that is really important, you know. So many people don't use the company secretary anymore, but it is a useful tool to utilize. Sorry.
Yeah,
So
absolutely. No, absolutely. It's just about ensuring that what you need to happen in an event like that can happen and can happen smoothly. So people should do what I call disaster plan. Now, what we typically don't do when we sit around the table having a roast on a Sunday is say, okay, let's imagine that mummy or daddy dies. What happens next? Because it's quite morbid and doesn't make for a happy roast dinner. But what is really, really important is taking time to appreciate what a sort of tragic event can do to your family and can do to your business. And therefore, we need to think about what we're leaving behind and to whom. If we have children, how old are they? If something happened to two parents of a young family household and there's a business involved in that, into whose hands is that business going to fall? If those children are under 18, or even if they are 18, is it appropriate that they have access to that business and it falls into their sort of receivership? And then other things that one could do is thinking about making gifts in their lifetime. So that's about transferring the value outside of your estate to reduce the value of your estate, so that on death, the value is lower and there's less inheritance tax to pay. Now, that doesn't have to be in the hands of someone. You don't have to give an outright gift to your children or a relative or someone else for that matter. It can be into a trust environment. And I'm going to touch on those a little bit later on as well. And then finally, just one other effective point is creating tax efficient legacies. So there's nothing wrong with saving and investing in such a way where you are almost putting a down payment on a future or perceived tax liability. So enabling your beneficiaries, your family, to be able to meet the cost of inheritance tax in the future is a perfectly reasonable method of planning and a path well trodden. Even things like whole of life insurance plans, that will pay out a specific amount on your death. So lots and lots of things that people can do to be proactive.
Fantastic. So the comments are working. So our lovely John is watching. Hi, John. Haven't seen you for a while. Good to see you. So please do. Tom is very happy to answer whatever questions. That would be great. Next thing I just wanted to ask Tom. So this is something that clients often ask, and sometimes I'm not quite even sure what they're asking, but they'll say something like, "Oh, my friend down the pub," the usual thing, or at the gentleman's club, wherever they've been, but they say, "Oh, they're mitigating their any tax because they're using a trust." So, in the purposes for inheritance tax, are trusts useful? How do they work? Are they irrelevant? What's your current thoughts?
Yeah, it's a great question. Trusts are very, very useful, very important, and very relevant. They are one of those strange things in life where everybody's sort of aware of them, but no one really knows anything about them. But they've been around for centuries. They date back to the Knights of the Realm, when knights would go off in medieval times on quests, and they would entrust their assets while going on a quest to, I don't know, their squire or their family or someone else, not their family. And the idea being that you would keep those trusts safe, and if the knight was unsuccessful in their endeavor and didn't come back from the quest and had died and met their end, then the specific instruction would be given about what would happen to the knight's assets. And the same thing applies today. That's still how they work. And I talk about everyone knowing about trusts. Infamously, the Duke of Westminster has a sort of a nearly £10 billion fortune on which no inheritance tax was paid by its most recent beneficiary. And that's because of very careful trust-based planning. But trusts are great. What they are is effectively a document whereby someone creates a trust, There's people that manage it, called trustees, and there's people that potentially or definitely receive assets from it, called beneficiaries, because they benefit from it. But what trusts can do are they can protect assets. So on the one hand, you might think that you want to give some money to your children, they're not quite ready for it, and so you gift this money instead of as an outright gift to your children into a trust environment. The trustees that manage that, which might be very close friends of yours or relatives, or even yourself as well, you can be a trustee, they decide, they use their discretion as to when the beneficiaries will receive those assets. So if you imagine a husband and wife, they've got quite an unruly child who is about to turn 18, and they might otherwise be able to get their hands on certain assets. The trustees can use their discretion to say, actually, we're going to wait till our miscreant child, little Johnny, reaches 25 years old before we'll let him have those assets. It might be that Johnny is going out with someone and intends to marry someone who the parents don't approve of and think this is a marriage that is destined not to last. And what we don't want to happen is we don't want Johnny to get these assets and then on divorcing this inevitably sort of unkindly relationship, that his wife and soon to be ex-wife can inherit a proportion of those assets, or receive a proportion of those assets as well. So protecting assets by way of divorce, it also works in the same way for bankruptcy. Assets can also work, trust can also work to advantage in terms of protecting assets from means testing around state benefits and also long-term care planning as well. Again, that's probably something for another conversation. But means testing by the state, by the local authority, trust planning sort of takes those assets out of the equation.
Oh, interesting.
You do have to be careful about, any form of sort of deliberate deprivation of assets. If the local authority can see that you're obviously doing that, then there are mechanisms in place to stop that. Control is another great aspect of trust. So again, if a husband and wife wanted to put some money away for their children, but they wanted to retain control over the assets, about the nature of how they're invested, what they're invested in, and when they're distributed to their children, that's where they work really well as well. And then the final thing that lots of people don't know about, but I think is just immediately valuable in the event of someone's death, is that any assets held in trust bypass probate. So anyone who's gone through the process of losing a loved one or someone close to them will probably have come into contact with the slow nature and deeply bureaucratic nature of probate. It can take a year sometimes for probate to be granted, sometimes more in complex cases. But assets held in trust are outside of the estate, so we don't need to wait for probate to be granted for the executives of someone's estate to start distributing that in order for the money to reach the individual. So in practice, what that means is if I had assets held in trust, and Nikki, again, I was going to leave those to you, I died, they can go to you the following day.
Wow.
And that's the benefit of using trust, because outside of my estate.
And that's often applied to things like life insurance policies may be under a trust, or your pension is usually via a trust.
Absolutely.
So that's good to know, because also to remember that, because if you're actually looking at how much are you worth, liquidating it with all the insurance and all that, you've got to remember some of that may be taken out of the probate calculation anyway, or the inheritance.
Yeah, absolutely. And pensions are a great shout on that, because they are a way of sort of having your cake and eating it. You're putting your money into trust outside of estate, but you can actually take it out and use it for your own benefit as well.
But a good point on the pensions thing is to remember, because you'll have probably put in some person for that trust, named them when you originally set it up. And I mean, feel like me, you've probably got 5 or 6 different pensions, and you've probably forgotten who they even were that you wrote down. It's good to go back and check who did you write down as being the beneficiary, to make sure that they are updated. Because I'm not a rules expert, obviously, but I believe you've got to be careful in case there's a conflict with your will and what's been put on the trust.
Yeah, definitely. So it's called an expression of wishes form, and you're expressing your wish to the trustees of the pension that they pay that to the individual that you've expressed.
Oh, I'm so sorry.
Bless you.
I'm so sorry. I've got a question's come up, Tom. I think we may have to make some assumptions on it. Claire, the lovely Claire's asked a question saying, apologies, I lost the call at the beginning of the trust bit. Can I put my property into a trust? What are the tax implications? So should we go through two different examples of if it's your property that you're living in versus a property that you're renting or something?
Yeah. So in theory, we can go through two examples, but on the latter example, I'm not the person to ask on that. So when it comes to things like rental properties,
yeah, sure.
So I'll tell you about what I do know. How about that? So
perfect.
When it comes to people's property, excuse me, generally people will say to me, can I sign the deeds over to my children? And then I don't own it anymore, and we don't have to worry about the house getting caught up in inheritance tax. The problem with that is HMRC have wised up to that, because if you assign the deeds over to the kids, and even if the kids don't live there, or even if they do, and you live in there, HMRC regard you as not really having given it away. And the term they use for that is called a gift with reservation of benefit, because you have reserved the benefit of living in there. And unless you pay a market rate of rent to your children, that is not a true gift. So it's essentially entirely null and void. What people do typically do when it comes to trust planning with their property is, you imagine a married couple, they typically will own the home jointly. So they both own all of it. What you can do is you can split the ownership into two equal halves, 50-50. You then become what's known as tenants in common. And as one gets older, one might become more and more aware of or concerned about the cost of care in the future. So what you then do with your single 50% share is you each write into your will that on your death, your share of your property goes into a trust. And it would be a private client solicitor that does this with you. Sometimes I think conveyancers can get involved in that. I'm not entirely sure, but the concept remains. 50% of property goes into a trust, and that's held in there for the ultimate benefit of your children, your beneficiaries. But the surviving spouse can live in there. So let's assume the husband dies, his share goes into the trust, the wife's still living there. The wife lives on another 15 or so years, then it becomes clear that she needs to go into a care home. Now, when the local authority are assessing the value of her estate for means testing to work out how much she should contribute towards the cost of care, because half of the value of the home, or half the ownership is inside a trust, the local authority can't force the wife to sell her home to pay for the cost of care, because she doesn't own all of it, and you can't sell half a house. So we call that severance of tenancy, and it goes into a special trust, which means she can continue living there while she benefits from it, and ultimately it will go to the children. And that's a way of protecting the home specifically from being sold to fund care fees. With regards to rental property, that's more out of my remit, so I can't.
No, that's fine. Just going back though to, so if you've say it's just you've got your own home, and you put that into a trust for your children, for example, and you did pay a market rate to your children for living there, would you therefore it still be okay to be outside the purposes of IHT because you are paying the rent?
I think you'd have to seek specialist advice on that. It's a murkier area, but generally speaking, in order for the gift to have been valid, those are the sort of qualifying those are the sort of qualifying factors that need to be in place. That you've given it to your children, they're a landlord, you're now their tenant. But even it gets further foggy, because actually there are special rules around renting from family and things like that. So that's an area where specialist tax advice should be sought, but people do have to be careful about that. Another small example is, let's say someone has a yacht, and that's a valuable boat, and they give that away to their children, but every Saturday they're driving around on a nearby lake on it. That's also something that could be deemed to be an incomplete gift, or more likely it's called pre-owned asset tax. So again, it's HMRC wising up to these ploys for people to reduce their estate, but not really doing so.
Yeah. So we're back to sort of at the beginning, it's really for personal circumstances, definitely worth sit down with a wealth management planner or inheritance planner who can understand what exactly is in your estate, therefore how much is your estate worth, what legitimate mitigations can you make. So always go and find out for your personal circumstances.
Definitely.
Absolutely. Okay. Claire says, important not to fall out the kids. No, they raise your rent. Not good. They evict you. But that is a good
Quite
point,
right.
though. That is a very good point, though, because a lot of people do think, oh, well, that's fine. I hope I'm going to live at least 7 more years. Therefore, I'll gift away a lot of my wealth to my children. Very important. You've got to be very careful how you do that, because what does happen if you fall out with your children and you've gifted them? You can't just say, oh, I've changed my mind, I'll have it back. You've got to be super careful. And that's where sometimes things, by putting it in trust, but with rules, that can help it. But, I always say you have to be very careful, only really give away what you can afford to give away and not give back. You need to trust and retain control. You've obviously each circumstance different, but be super careful about what you do.
Yeah, absolutely. And when one is seeking advice, even on an ongoing basis, that's really important, because it might be sort of assessing up front about your inheritance tax situation. But actually, if you are planning on making a gift and you're not sure what the implications of that are, whether you can claw that back and go back and with your hands put together begging for the money back, you want to make sure that you understand everything.
Yeah, absolutely. Very important. Okay, great. Well, there's a good little sprinkle of questions in there. And there was one other area that I wanted to go through. So we've still got a few more minutes. Let's squeeze that in, but really important. And this is extremely important. So as you know, I've got quite a few clients in succession planning about to sell their businesses. So at the moment, as long as it's a qualifying business, so check that it will be exempt from IHT. However, as soon as they sell it, which, touch wood, fingers crossed, about to happen, then they've got that cash in their hands. That's then again straight available for IHT consideration. What would you say to those people? How that's very exciting that they've got that money now, but now they've got an IHT problem. So what would you, besides obviously go and see an expert, what sort of things could they be considering?
So there's a whole array of things that one can do. So again, it would sort of invite a conversation back on the subject of trusts and and ultimately ensuring that what they feel they don't need in order to cater for their income in retirement, if that's assuming what they're doing, is outside of this debt. So the most important thing is understanding what one wants to do after the sale of a business. And for lots of people, it's just maintain the current standard of living, or some people might want to step up a gear and sort of sip cocktails on a boat. Other people want to ensure that they put their money in an environment that is sheltered from inheritance tax and can ultimately be feathering their nest for the future and their children or the future generation, leaving a legacy. I think the most important thing when it comes to inheritance tax and business owners is that, much like an individual, they too are thinking about all the important documents, all the important considerations that they should put in place, because they're so busy ordinarily on gearing the business up for scale and ultimately for sale that they lose focus on what might happen if in the event of their death or sickness or loss of mental capacity, what might the impact be on their wider family. So it's really, really important that business owners take the time to understand who have they left their business to in the event of their death. If that goes to their spouse, is that okay? And much like you were asking me, Nikki, what does that mean for the inheritance tax treatment on the value of that business asset? Again, have you put a clause in your will and your lasting powers of attorney that specifically pertain to your business interests? And what are the commercial implications of leaving your business to your spouse or your civil partner as well? If you don't have a will, that will automatically happen. But what if you had another partner in your partnership, or a co-director in your company? Where does that leave them? Because they're now in business with your spouse. And that can present difficulties as well. And again, you mentioned business relief as well. Not all businesses do qualify for business relief, so it's important that people take advice to understand, does it? And for those that don't know what I'm talking about, when I say business relief, generally business assets, if held for long enough, will qualify for 100% relief from inheritance tax. So again, understanding the implications is so important. It's tricky to comment on specific scenarios, of course, but ultimately, if one sells their business and receives a big nest egg, then the treatment of that is going to involve trust-based planning, investment-based planning to ensure that money can be hedged against inflation and continue to work, but also setting that up in structures whereby income can be received, and ultimately we're mitigating tax. So it really, really depends. But I think, the one thing we should all remember here is, we all typically don't like paying tax, but tax should not always be our major priority when we're thinking about planning. Actually, the impact of a lack of planning on our family, on those that we're in business with, that should take priority first, and then we should look at the tax implications alongside that.
Absolutely. Well, we covered so much in that half hour. That was brilliant, Tom. And as long as you're happy to do so, we'll definitely revisit this topic and pick up some of those themes a bit more in depth. Because it is really important. It's important to have those conversations with your family, your friends, people that are going to be affected by the death of someone. So it is important to talk about. So Tom, where can people, if people would like to have a chat with you, if they're going via LinkedIn, you should be able to see Tom's details. Where else could how best ways to contact you, Tom?
Yeah, I think that's a great start. LinkedIn, you'll see my face and my picture. Just sort of click on there and slide into my messages, as they say. One thing people can do as well is look at our website as well. So Frizzell Wealth Management. We're based in South Oxfordshire, also offices in London as well. So always happy to have a chat. And look, the funny thing about inheritance tax is it seems to sort of touch the desks of lots of different professionals, whether it be someone like me, whether it be someone like Nikki, a private client solicitor or a commercial solicitor. At the very least, talk to someone, reach out to them, because if they can't help you, they'll point you in the right direction of someone who can. And face up to these things that might seem like a boring chore, but actually are really, really important when you take time to consider them.
And your beneficiaries will appreciate that you've done some forward planning.
Absolutely.
Right. So thank you very much, Tom. Next week we are going to be talking succession planning again with Nigel. I'm not sure which part we're talking. We're probably I feel like we should talk about heads of terms. I think that's a good place to talk, especially as I've got so many versions of different ones on my desk at the moment. I think that would be a good part of the process to focus upon next week. But in the meantime, everybody have a good weekend. Who knows what Prime Minister will have next week? It's all go at the moment in the UK. But anyway, thank you very much again to Tom. Any questions, please do reach out, and cheerio and have a great weekend.
Thanks.